All right, so we are getting started. Hello, everybody. So today we are going to be building out on a napkin. Okay, so I'm going to show you what napkin math looks like. Um, and we're going to talk about going from single families to multifamilies. And this is a great topic right now to talk about. Well, it's always a great topic to talk about, but more so right now because in February we ran through a similar analysis to the Edmonton area. And so today we're going to analyze it for BC, and it's also relevant for Toronto because of some of the new bylaws that have come through in the last year or so for Toronto, and then BC recently in their bylaws. So we're going to run through the single family to multifamily multiplex conversion and see what the numbers look like there. Okay, so that will be our deal analysis for today. So at the end of today, one of the things that I'm hoping for from these shows is to help fellow accredited investors understand the real estate market and what other strategies there are out there, so that we can make investments with confidence and just making good, sound investment opportunities. Okay, so that's the outcome here. So one of the things that I always get from people is, well, Hung, what is an accredited investor? And it's funny because when I found out what an accredited investor was, I actually didn't even know that I was one. And so even though I've read the Rich Dad, Poor Dad series and, I'm in real estate, I actually didn't know what that was until somebody who wasn't even in the industry said, Hung, are you an accredited investor? And here's all the criteria. So, you know, to figure out if you're an accredited investor, I would say, okay, Google what an accredited investor is because um, the the criteria for an accredited investor changes over time, and it depends on what country you're researching this on. So usually all the stuff that I do is in Canada, so I would just Google accredited investors in Canada. It's based on your income, your net worth, and of course where you live. Okay, so the when I first heard about this, I was like, I was always on board with this accredited investor criterias and the reasoning behind it because it really gauges whether or not you can handle when the investment goes badly. Okay. If you aren't an accredited investor, you're probably going to be hit a lot harder financially when things go bad. And a lot of times, there's things happening outside of our control that, you know, these things are put into effect for a reason to help us. Okay. So, when I think about the US market going under in '08 compared to Canada going under in '08, Canada had a lot of regulations in place that actually helped us from crashing like the US did, right? Like, we did suffer a bit in the '08, '09 crisis, but not as badly. Okay, so so I'm definitely in support of the accredited investor criteria. And so, I would say just Google it. And if you are an accredited investor, please reach out to me. I'd love to have a conversation with you about what you're doing. And, maybe there's a learning opportunity for me and vice versa. Okay. And, because I am an accredited investor, there's been so many so many other opportunities that I have been able to take advantage of because I'm an accredited investor. So I'm just going to share with you one opportunity that I've been able to get into in the last year. It was a $500 investment. So not a big ticket item at all, right? Like our groceries for the month, right? So $500, and that got me a 20% return. And that 20% came back to me within 3 months. And with that, everything after that was a 6% return. Okay. So maybe not on this call because I didn't plan to run through this, but it may be a good idea for me to walk through why a 20% return on a $500 investment in 3 months really makes sense, and why a 6% return after that is actually a really sound investment. But now here's the thing. If I was not an accredited investor, I would not be able to participate in this investment opportunity. Okay, so I will put that on my list of items to capture the next time. Okay, so you are watching Money Matters. I am Hung Lu. Hello, hello. I'm with Cash Property, and today we will go through yeah, the single family to multifamily land development. And then I have 3 questions that came in. So hopefully we have time to cover those 3 questions. If we don't, then maybe I'll push those off till next week. So before you go and implement any of the stuff that I'm talking about, or take any of the questions that I answer and take them and run with them, please just keep in mind that, this is for information only, for educational purposes. And, I'm not really promoting an idea, or sorry, promoting a strategy or a product or a service. I'm really just saying, hey, these are some of the stuff that I'm working on. These are some of the things I know other people are working on. These may be a good fit, may not be a good fit for you. So please, before you implement it, go and do your own due diligence. Talk to another investor. Talk to your financial advisor and see what they say. Okay. And of course, if their ideas are, if their comments are different, please let me know. I'd love to know why it's different. Okay, so that is the 1-minute disclaimer there. Okay, so the questions I will put to the side. So let's get into this napkin math about multifamily. Okay. All right. So recently there's been, with the change in the interest rates and the economic situation that we're in, it's been increasingly difficult to find properties that cash flow at the interest rates. Like a lot of the deals just don't work because there's not enough cash flow to warrant it. The appreciation may be there, but you know what? That's also a bit of a gamble. It's gravy money, which is fantastic. So one of the ideas here is to say, okay, well, instead of buying for cash flow, how can we buy and force the appreciation? And so one of those strategies is land development. Okay, so you take a single family lot, you tear down the house, and you put a multiplex on there. So whether it's 3, 4, 5, 6 units, right? The more the better, maybe. It depends on the cost of the build. So let's go into some what I would call just like a napkin math, because you want to just sort of build this out at a very high level, like think of what napkin math is, right? Like you just putting your idea down on paper at a very high level. Does it make sense? If it makes sense, then keep going with it, right? So let's see here. So let's just make sure I'm sharing my screen. Okay, sharing your screen will close. Okay, so good. So you should see the whiteboard. Okay, now I'm not very good with the pen mark. So what I'm going to do is I'm just going to type out my napkin math here. So just assume that, that I'm writing here. Okay, so with land development, so pretty much this, single family units into multifamily is basically land development. Okay, so we're just going to call this land development. And so one of the things that you want to consider with land development is the land cost. Okay, so basically, how much is it going to take for you to buy this land? If there's an existing house on it, you may need to pay a little bit more because of that physical home there. You will have to pay for demolishing. If there's been, like with these new bylaws coming by that is allowing us to have multiple units on it, the real estate agents may tell that the homeowner, hey, you could sell this for a little bit more because of this potential, right? So the land cost may include the future potential of what could be housed on that land, right? Which would be the highest and best use of the land. Okay, so you're going to have the land cost. Okay, then you're going to have the soft cost. Okay, so the soft cost would include anything from drawings, permitting, any holding costs that you may have. So like if you have to pay for a private lender, if you have to, so all of those soft costs, right? So all the fees, everything, legals, all that stuff. So the soft cost is usually for the duration that you have to hold it until it's shovel ready. Okay, so like by the time you're digging into the ground, but then also including the time that you're building. Okay, so the soft cost doesn't just change, like stop when you're shovel ready, because while you're building, you also have those extra costs as well. Okay, now some of those soft costs may change. Like, so for example, like your architectural cost is only, until it's shovel ready, right? But then after that, you're still paying, let's say for hydro, you're still paying land transfer, the property taxes. Okay, so those are the soft costs. Okay, then the third thing that you have to be aware of is the actual hard cost. Okay, and the hard cost is your building cost. Okay, how much does it take to build? Okay, this number changes depending on the city that you're in, based on how much labor cost is, how much materials are. This number will change, and it changes also by the developer, like who's actually building it for you. So when I was looking at my 8-plex builds in Edmonton, I was getting prices anywhere from 190 to 250. So that's $60 per square foot is a huge range, right? And the higher your build cost, the less profit you're going to see. Okay, so we'll get into why that is afterwards. So this hard cost here, it's based on how big you're going to build, right? So if you're building units and let's say they're 1,000 square feet per unit, well, then you're going to be basing your numbers based on 1,000 square feet per unit for how many units you have. Okay, and at some point you get to the number of units where it just doesn't make sense anymore, or if it's too low of a unit number, then it doesn't make sense, right? So there's like a sweet spot of how big your units need to be and how many units you need to have. Okay, so usually when I'm doing like my development projects, I make sure that I'm talking to a lot of developers, understanding what their fee structure is, what the build cost is. And a lot of times when you're talking to people, they'll just give you like a build cost number, right? But then you need to ask, hey, does that include the soft costs? What else does that include? Does that is there already septic and hydro? You know, like is the road fees already included, right? You may have to pay for all that, okay? And depending on where you're building, you may have like the municipality may not want to actually help you, and so they're well, let me rephrase that. The permitting, the getting to the point of getting your permits may be a little bit more difficult depending on how open this municipality is to developing. Okay, so in Toronto and Vancouver right now, you know, with the new bylaws that have taken place, and in Edmonton, the bylaws have changed in favor for density. So they are, you know, supporting the development. Okay, so it's in our favor to acquire land and to build if we can. Okay, so that's the hard cost number. So now all of that, now the fourth thing, which I find a lot of people when they're doing their calculations miss out on. And this is what I like to call buffer or contingency. And I learned this big time in my engineering job because we always carried at least a minimum of a 10% contingency. And this is for overruns, okay? So this buffer for me is anything that we sort of like potentially could have missed, okay? This was a big thing because one of my developer friends missed out on a $1 million fee. Okay, imagine like you're running your numbers, and if your profit is 2 million at the end, like if you're anticipating a $2 million profit and you missed out, like you didn't know that there was an extra $1 million fee somewhere within, you know, a requirement, you've just lost half of your profit. Okay, that's huge. Okay. All right, so your buffer. Okay, so now you take all of that in, okay, and I'm just going to go back here. Let's see here. So now this is your final cost, right? Your all-in cost. Okay, so this is now your all-in cost. Okay, so now once you have this number, this is just a part of your calculation, because the other part of your calculation is, okay, well, if you're going to sell this, okay, now this is where it's different from the February 12th show that I did. In the February 12th one, I was talking about holding it and keeping it, right? Like my fallback strategy is to buy and hold, right? For generational wealth. So now in this one here, if you decide to sell off the units or sell the building to somebody else, which is another exit strategy, is you have to figure out, okay, well, how much can you sell it for, right? So this is the sale price. how much can you sell it for? If you're going to go and sell off each of the units, okay, like if you're going to stratify the building and then sell it off to homeowners, like potential future homeowners, well, how much can you sell each unit for? And then what is the total profit that you're going to get, right? Okay, so the all in minus whatever your sale price is, okay, and minus all your fees, right? So if you are having a realtor involved, any of your legals, all of that factors into this. Okay, so now that's going to be your profit. Okay, so this here, okay, so you have to include all of your fees, right? So your legals, um, legals, okay, and then your agent fees too, right? So, and any sort of that stuff that's in there. Did I spell legal wrong? Huh. Okay, so then, okay, so then that's your profit. So you want to make sure that you're going to have a healthy profit, and that if one of your other numbers here is off, that you're not going to be in the negative profits. Okay, so you definitely want to be in the pluses here. Okay, so now let me run through some numbers that may go with this. Okay, and let's just see if we can make this give you some better ideas here. So let's just say in Vancouver right now, you could buy a single family lot for, I don't know, 2.53 million. Okay, so $3 million. Okay, that's a single family lot. Okay, you know, maybe going to 4 million on the top end there. So you want to buy the land cost for as low as possible for the biggest lot size possible. The bylaw in Vancouver and area is you can go up to 6 units or 8 units depending on your size of lot, where it's located, so forth like that. So there's a lot of details out there on that. So let's just say that you're buying the land, it's about $3 to $4 million. Okay, so as you can see, this is bucket math here. It's not very precise, it's not detailed yet, but it'll give you at a very high level if the numbers make sense and whether or not it warrants to continue researching. Okay, so now we're going to go into the soft cost. So for the soft costs, you want to ask your developers who have the experiencing, and you want to talk to multiple developers here, not just one or two. Okay, so usually the soft cost ranges anywhere from, I would say, about $100 to maybe $225 per square foot. Okay, and that's based on how big of the building you're going to build per unit, right? So let's just say I'm going to go over here and I'm going to do another box here, text box here. So let's just say you're going to do 5 units, okay? And each unit is 1,000 square feet. Okay, so it's like a decent size 1-bedroom. If you want to do a 2-bedroom, then you're going to go obviously up higher in the square footage, right? Okay, square feet. 1,000 square feet units. Okay, so then that's going to be 5,000 square feet. Okay, for your building. And you're going to also want to include some common spaces as well if you need that. Okay, so I'm going to assume that there's no like fancy common spaces here, like no gym, no pool, no nothing. It's just a main hallway, maybe, you know, like the foyer, the staircase. Okay, those are common areas. So 5,000 square feet. And if you're going to build this at, oh, okay, so this got moved over here. So let's see, can I expand this? Yeah. So if it's so I'm just going to go with the 5,000 square feet. So if it's at $100 here, okay, so you're basically just going to, you know, pull out your calculator and just do a very quick math. Let me see what we got here. So 5,000 square feet, okay, times $100, right? So that's roughly about 500K. Okay, if it's at $100 a square feet, all the way to 225. So you just go back in your calculator and 225 times your 5,000 square feet. So that's $1.125 million. Okay, so that's the range that you're going to work with for your soft costs. Okay, so now if you're building, let's say 8 units at 1,000 square feet, then your numbers are going to be higher. If it's 5 units, let's say, but your square footage is lower, then your total square feet is going to be lower. So then your soft cost is going to be lower too, right? And then depending on your range of the fee for that soft cost. Okay, so hard cost now, this is also a range. Okay, so I'm just gonna see if I can copy. Can I copy this right down? Maybe not. Oh yeah, okay. So here, usually the build cost is a higher number because this would include your materials, labor. There's also a bit of a contingency in there as well for overruns, project manager fees, all of that stuff. So this could be anywhere from, okay, so now we're using the example of BC here. So BC, okay, even though it, stands for bring cash or bull crap sometimes, I'm going to put in 300, which is on the low end, to 450, okay, a square foot. So when I was doing my analysis for Edmonton, I was around, the 2 to 250 range, or like the 190 to 250 range. For Toronto, it's it's closer to the 250 to 400 range. So in Vancouver, it's about 300 to 450. Okay. If you can get 300, you're doing pretty well already, pretty good with your developer already. Now, the thing is that you want to make sure that you're not giving up quality, okay, in your build, because you shouldn't have to sacrifice quality in terms of your build cost, because you want quality, like the level of the build at the end will dictate how much you'll be able to sell it for. And if you build at crap quality, it's a small enough industry that people will eventually like not give you good reviews. Okay, so I'm just putting that out there. Okay, so then you do the same thing. So you then take your 5,000 square feet. Whoop. Okay, so 5,000 square feet times 300. Okay, so that's 1.5. So this makes the math a little bit easier. So 1.5 million. Okay, so that's the $1 million price point at that point. And then the other range is to the 450. So that's 2.25. Okay, so 25 million. So now let's just say your buffer is 10%. Okay, now your buffer is the buffer on everything. So if you look at the math here, you're going to say 2.25. So I'm going to go at the very end here because that's the range that they gave me already. Plus 1.125 million plus my 4 million, okay, is 7.3 million. So if you take that and you times that by 10%, then that's about 7.375 thousand. Okay, so on the high end, you're going to have that much buffer. See, that's why I like using Excel, because then once the numbers are in, you just put in a formula and then it just calculates everything for you. Okay, so now I'm going to go to the low end here because I want to know what my buffer is. So I'm going to go 3 million plus the 500,000 plus the 1.5. So that's 5 million times my 10%. So that's 500,000. Okay, so 500K. Okay, so that is all of my fees combined together. So can I do that? Yeah. So all of that going across. So now my all-in cost is going to be just basically the sum of all that, right? Okay. So let me see. So 3, 4, 5. So this is going to be 5.5 million. Okay. And then the next one is what we got, 5.125 plus 2.25. Yeah. Okay. Plus 0.7375. Okay. So 8.1. Okay. So 8.1 million. Okay. So that's the range that it's going to take me to build 5 units at 1,000 square feet. It's going to be 5.5 million to 8.1 million. Okay. Now this is a huge range because there's like a, $2.6 million difference here, right? Like that's the range that I'm working on. So let's just say I can sell each unit, I don't know, for $2 million. Okay. So times 5. Okay. So if I can sell each one for 2 million and that's after all the fees and everything, right? So whatever the fees are, that's fine. And then I'm going to sell it for 2 million a piece at 5 units, that's $10 million. Okay, so then basically that means that I'm going to have a profit. Whoop, how come that one changed? Okay, somehow the formatting, they changed there. Okay, so if I go across here, so if I can sell them at make $2 million profit per unit, okay, which is fantastic, then I'm going to see a gain of 4.5 million to 1.9 million. Okay, so now you can see that the math here is a little bit backwards here. So I'm just going to go back here, 0.9 to 4.5 million. Okay, so that's the profit range that I'm going to go see. But now let's just say for some reason I recognize 1.5. Okay, so now if you take 1.5 times your 5, okay, then your profit range is going to be a little bit different. Okay, so 1.5 times 5 is 7.5 million. Okay, so 7.5 million. Oh, that's okay, so 7.5. So let's just say that worst case scenario, it takes me 8.1 million to build this. Like everything's overran here, okay, at the top end level. Okay, that means I'm in the hole by $600,000. Okay, so that's where there's a bit of a risk because you could potentially be in the negative. Okay, so let's just say, so this is very similar to doing flips. You could lose money on the buy because if you're overbuying, thinking, okay, well, it's okay if I pay the higher price because we'll just make up for it in the build costs or in the after repair value. Okay, so that's one of the mistakes that I see all the time with flippers. The second thing is that you are overrun with your build costs, your soft cost, your hard cost, and your buffer. You don't give yourself enough room. Okay, or even if you give yourself enough room, but then there's a change in the economy and you have to hold your property for an extra 6 months, or all of the materials cost longer, right? And we saw that during COVID, significant, like huge delays in getting material, huge delays in holding costs. And then we saw an increase in private lender fees. Okay, so if your build cost is significantly higher, okay, and then the third area that you could potentially miscalculate that will cause you to lose money and put yourself at risk is that your sale price, right? If you're anticipating a $2 million price, but then you can realistically only sell it for 1.5, okay, after all your fees and legals and all that stuff, well, then you're in the hole significantly. Okay, so those are the things to consider. So based on, like if I ran this and I applied it to BC, okay, with what we have right now, having title on a large 1-bedroom unit, 1.5 is about the going rate. Like maybe 2 million would be really good if you're, building it nicely, having top end appliances and all that design stuff, right? Then you could be up at the $2 million range. Okay, so if you can build this and you're really good at keeping your numbers down and partnering up with people to get your prices down to the 5.5, then there's lots of money to be made here. Okay, so now we're going to run this scenario, same thing for Toronto here. Okay, because here's the thing to keep in mind. This strategy works in BC because the level of appreciation that we've seen in Vancouver and areas of BC for a while. This becomes a little bit riskier in Alberta because we may not see the appreciation. The after repair value is not as high. Okay, yes, the land cost is low, the building cost may be lower, but at the end of the day, you want cash flow, you want appreciation, you want mortgage paid on, like you want all of that as much as possible. Okay, so now let's run through the Toronto situation here. So in Toronto, you could buy a single family home for about 1.3 million to 1.7. So as you can see, the single family lots are a lot smaller. So soft costs, I would say probably about the same. The building costs, maybe 250 to 400 for Toronto. And then the buffer would be the same here. So then you would have to adjust these numbers accordingly. Okay, so these numbers here would change. Okay, and then your buffer number would change as well. Okay, so let's just run through that quickly. So if we take 500,000, no, so 5,000 square feet, okay, times 250, you're looking at 1.2, yeah, 1.25 to 400, so 2 million in the build. Okay, so then your buffer at 10% is just going to be the sum of all that. So then if you go 1.125, yeah, no, 25, sorry, 1.25 plus 1.8, so that's 305 times your 10%. Okay, so that's just, did I do that right? No. Okay, so you have to make sure that you put your brackets where they're supposed to be. Okay, so 30.5. Okay. So 305. Oh, I've lost my mouse here. Okay. 305K all the way to there. Okay, so you may not have seen that, but I typed in my number and I didn't use the math formula. And so it gave me a different number. And part of doing your analysis correctly is knowing when your calculator is giving you a wrong number because you made an error, okay? And you want to make sure that you're good at your analysis so that you catch yourself when you make a mistake like what I just made. Okay, so okay, so so I'm going to go to the next one, 2.825 plus my 2 million, so that's 4.8 times 10%, so that's 482.5K. Okay, so now that's the range that I'm going to be working with. Okay, so then my all-in cost is going to be, whatever that sum of that is. So let me see here. So 2.825 plus 2.482. Okay, so that's 5.3 million on the high end, 5.3 million for the high end, and then the low end is going to be 1.8 plus 1.55. Okay, so 3 million. Okay, so 3.35 million is the range. So that's going to be my all in. Now, can you sell like strat units or individual units? For a fiveplex, you're not going to really be able to sell it for $5 million. Sorry, for $7.5 million. For a 5-unit building in Toronto, you might be closer to $5-6 million. Okay, so that's where you're going to want to know your market there. So if you can sell this building for 7.5 million, then you've got a positive gain here of about 4.15 all the way to 2.2, right, which is great. Okay, so you're at 2.2 million there for the Toronto area. Okay, so this works great in Toronto. Now the lots in Toronto are a lot smaller than what they are in Vancouver. So that's the main thing that you'd have to look for, is to make sure that you are able to put in 5 units. Like some of the properties that I have in Toronto, they won't allow up to 5 units, like 3-4 units is the max, right? So then this would definitely change what my after repair sale price would be. Okay. All right. So we are done with that calculation. Please, if you have any questions about this, please do reach out to me. I am happy to continue this conversation further on single family conversions to multi-families. Okay, now the other thing that I should put in with that calculation is that I am assuming that you need to demolish whatever is existing there. Because if you take an existing building and if you can just convert the inside but keep the physical structure out, then that actually will be a cheaper cost, right? Because now you're not redoing the foundation, you're not doing the outer build, you're just like the shell is still there. Okay. Now, if you have to gut it, then there's going to be some additional costs to basically gut the entire thing. And it's actually, it may be better to completely gut the whole building because now you're starting completely fresh. And in Toronto, when you completely gut a building, then you actually are able to take advantage of the new rules around the landlord tenant board where there is no rent control if a building is built after a certain year. Okay, so I'm going to stop it there for now. If there's any questions around that, the rules around the landlord tenant board stuff, please feel free to send me a message on the QR code and I will reply back to that. So let's get into the 3 questions that I have. So how are we doing for time? Okay, so let me go into one question today and then the other 2 I will leave for another time. Okay, so this one here is somebody sent me this and said, hey, Huong, does it make sense to invest in an 8-year project? So investing into a project for 8 years and seeing 23 to 28% return. Okay, so so that's the problem with getting some of these questions is that there's just not enough information, right? So if I'm doing a project and it's my team and I'm going to be in it for 8 years and making 23 to 28% a year. So I'm assuming it's every single year, it's going to be that long and that I'm going to see like I'm in control of that project. Then 8 years is not a long time. And 23 to 28% is amazing. So I would do it, especially if the opportunity was one where I was the key stakeholder in it. Where it changes is if you're putting money in and somebody else is managing it for you, then that's a different criteria, like a different situation. And if the 23 to 28% is not per year, okay? If it's 23 to 28 and then you have to divide that by the number of years, then that works out to be like 4% a year, which is not great, right? Like you might as well just put your money into a GIC at this point. But if it's per year that you're seeing that return, which is great. Okay, now here's the thing with putting money into somebody else's deals is 8 years is a bit of a long time. Unless you are in a situation in your financial state, like if you are in capital preservation, then an 8-year time frame, like your horizon, 8 years may be reasonable for you. If you're growing your net worth right now, like if you're trying to do a lot of these opportunities, 8 years is a long time to be locking your money in, okay? So then that would also then go to my next point is, well, what is the conditions for getting your cash out if you need it? And what else is included in the offering? Like, is there any pref, right? Meaning like, are they going to give you at least an 8% pref year over year, no matter what? And then the 23 to 28 is the top up, right? If everything runs well, okay? And then is there any sort of negative cash flow? Meaning, like, I don't know if this is a situation where you're investing into an existing multifamily as an LP, because if there's a negative cash call, then you have to put in more money, right? Or maybe there's a condition saying, okay, no, there's never going to be a negative cash call, right? Like what you put in is all the money you ever really have to put in, okay? And then that goes to my third point is, okay, well, what's the asset class here, right? If you already have a huge portfolio in multifamily and this is another multifamily, well, then are you taking too much risk by not diversifying your portfolio enough? Like maybe if everything you have is multifamily, then maybe look at a different asset class in real estate, right? So like maybe do warehousing or maybe do a commercial plus land, right? So there's different asset classes that you can invest in within real estate. Okay, so those are the 3 points that I would say to this. Like, yeah, without knowing more details, it's really hard to say if you should do this or not, right? Yeah, the one of the things that I used to say in the past was make sure you trust the partners that you're putting your money in. Unfortunately, we have the best intentions and we find the best people to work with, But then, what I've seen in the last couple of years is some of the people who I, would be a big supporter of, they've just over leveraged, or they've taken some, some opportunities that didn't work out. And so their intentions were there, and they didn't mean to do anything negative or do anything bad, but just because the way the economy is, the opportunity didn't work out, right? And so that also then leads to the point, well, okay, if this deal doesn't work out, can you handle the financial loss on this? It's not just not getting the 23 to 28%, but it's also, can you risk losing that capital that you put in? So if their minimum investment point is, let's say, 100,000, can you risk losing that 100,000? Okay. In some of the opportunities that I'm looking at, the investment is only 20,000, right? So the loss of 20,000 is not as significant as 100,000. But mind you, there's some opportunities that I'm looking at where it's $500,000. Okay. So, to $1 million. So if I lose $1 million, that's huge. Like, yeah, I would feel the pain on that, right? Okay. So you sort of want to go through all of those criterias as to, do you want to take this opportunity? Okay. So we are close to the 45-minute mark. So I am going to leave the other two questions till next week. All right. Thank you, everybody, for tuning in to another episode of Money Matters. My name is Hung Lu, and I will see you